People need an income that's guaranteed to them.
If you lose money to taxes, you're never getting that money back.
You need to get serious about adding some lower risk.
Greed. I don't like greed.
The thing to be afraid of, honestly, is the thing that we're not thinking of, the black swan event.
There's a tsunami coming. Bye.
Welcome to Retirement Coffee Talk with Charisse Rivers.
Just coffee talk.
There's a lot of noise, a lot of chatter. Who do you listen to? Who do you not listen to? You have to stay focused.
A fun and informative look at the issues of wealth, retirement, and protecting your life savings.
These advisors out there that were trained to sell, and have all these fees. They don't want to talk about this product, so they make less money.
And now, Retirement Coffee Talk with Charisse Rivers.
Welcome back to Retirement Coffee Talk with Charisse Rivers at Zinnia Wealth. Online, as always, zinniawealth.com, ZINNIA wealth.com. If it's time to talk about your retirement, let's get that conversation going. Charisse does a no-cost, no-obligation meeting about your retirement to sit down and talk about what's going in, what's going out, what do you worry about. Let's get your questions answered. Online, it is zinniawealth.com or 833-368-3680. And Charisse, she looks at herself as an educator, not only in the seminar room, not only in the conference room, but at home in the living room, because there was a massive game of Monopoly with your kids this past week. Tell me a little bit more. This is 6 hours you guys played?
Yes.
Oh my
I got to tell you, the fruits of my labor just really showed up over the weekend. And I'll tell you what happened playing Monopoly. I've been teaching my kids about money and playing Monopoly since the day they opened their eyes. No joke. We started early. We started with tic-tac-toe, okay, guys, and then hangman, but then we really worked our way up. We bypassed Candyland. And I got to tell you, my son is 11. My daughter is 16. They're about to age into the next category here in the next 2 months. But we played Monopoly. And we sat there for 6 hours and nobody wanted to go to the bathroom. Like 3.5 hours into it, we're like, we got to go to the bathroom. And I'm like, okay, let's all break and go to the bathroom. So we did. The game was so intense that they were so competitive that I had not seen this like true competitive side to them. And they're thinking through, okay, if I get this and I do this and we can wheel and deal here. It was the best game of Monopoly I've ever had in my life. And I've been playing Monopoly since I was in, I think, 3rd grade. My dad taught me. And I'm going to tell you, so my daughter, she got all the best properties. I'm like, dang it. She just got lucky. She kept rolling on them and she knows my game. I'm going to buy whatever I land on. Yeah. Right. So she was using my strategy and I would do too, but I was on the other side of the tracks. I was buying the ones that were like low cost, but I was buying them. And my son's strategy is like, I just want the Reds. I want Kentucky.
Indiana, like, Illinois. Yeah. Okay.
Yeah. And it's a good payout.
Yep.
And I'm like, buddy, you already know that you have to be diversified. You just can't have this one section on the board. He's like, I know I have to be diversified, but this is going to work. I'm like, all righty.
I can see
and
him.
I'm going to tell
okay,
oh my
Mom.
Gosh. I know exactly what happened. And so we got to wheeling and dealing and my daughter would not give me what I needed. So I finally was like, well, this game is never going to end. I was like, so, okay, fine. I'm going to let you have this, but you know what? I'm probably going to win just out of God's grace, right? And literally, we played for 3.5 more hours.
Oh, man.
We were not done. We were starving. It was 9:30 at night on a Sunday night because we had to get ready for Monday. We never do that. And so
Wow.
we were all still playing. And the next day, we continued to play that night.
Oh, wow.
After their homework was done. And Eli was the first one out. And I said, buddy, I told you, like, this is a lesson learned forever. Be diversified. Just don't pick one set that you're fixated on. You got to grab some of the other properties so we could have, you can have an opportunity. Then it was me and Ella. And Ella was like, I got you, Mom. Boy, did she have me. But she got unlucky because once we got our hotels and houses on all of our properties, like all three of us were like, I want to go to jail. I want to go to jail. Right. And we would roll because you had to pay to get out of jail or roll doubles. We were praying we were not going to roll doubles. So how she got unlucky is I got into jail. She had this big chunk of money. I didn't have any. I was about to run out. And then she started landing on my properties and she's playing by herself because I couldn't roll those doubles. And then she was out. She went, man, sometimes you can plan to you're blue in the face. He's like, but it doesn't always work out. I'm like, you know it.
Life
honey.
lessons. Here you go.
Life lessons. I'm like, that's why you have real estate in your portfolio. You have money in the market. You have CDs. You have this and you have that. She's like, I get what you're putting down, Mom. You don't have to keep telling me that. I was like, but I told her I was proud of her. Both of them. Like, I'm still talking about it because it was so much fun.
Someday Ella's going to have her own family and she's going to take them all on. And she's going, I learned this game from a financial advisor. Look out.
And Grandma's still going to be there whooping their butts.
I love it. I love it. Anyway, all right. Well, in Monopoly, you got to have money coming in. That is for sure. And in retirement, you got to do the very same thing. How do you figure that out? And that is what we're going to talk about now. Dana Anspach is a retirement planner, and she was interviewed by the website The Street. She said something interesting. She said, if you look at all that you've saved for retirement, take a look at that, your nest egg, as they call it. And she believes that 50% of what you have should be dedicated to giving you guaranteed income in retirement. I thought that was a big number. 50% of your portfolio should be there to pay you in your retirement years. Is that a unusual number? Is that a high number? Is that common? Is it vary? What do you see, Charisse?
So I have to say it's not cookie cutter.
Yeah.
So if you're somebody that comes in and has a high Social Security check and has a large portfolio, you're probably not going to need to have to plan for those income checks like someone who has maybe a smaller Social Security check and maybe less investments. So what happens, 50% of your portfolio can be in this income planning phase of life. So AKA a pension annuity that's giving you a guaranteed income stream for life, because you're buying income. And if you need more income than you had saved for, then yes, I can see a portfolio, 50% going into an income plan that is part of that guarantee for life. It's never going to run out. It gives people peace of mind and it allows you to spend more money. But if I had any way to do with it, I would prefer clients not to be in an income annuity. I'd rather them be in a growth annuity because there's more options, there's more growth. In an income annuity, there's typically a 1% fee. In a growth annuity, there are no fees and you can't lose. And even in an income annuity, you can't lose either. But it just depends. But here's the thing. How does a financial advisor or an insurance agent know which one to put you in? And this took me years to put together and figure out, but it is not cookie cutter. So when we build our income plans here, what happens is we say, okay, here's your Social Security check. And if you have a pension, we put it in there. And here's just your asset. And on this average return, if we don't put an income annuity in there, what does your asset look like 30 years from now, hypothetically? And then we'll say, okay, now let's take half of that asset and put it in an income annuity. And we look at it. I said, does that get you to spend more now and have more legacy later or less legacy later? And some people, it allows them to spend more now forever and ever, but you'll have a smaller legacy later. But some people, it's a higher legacy. So it is not cookie cutter. It is so dependent on what your expenses are, on what your fixed income streams that are already coming in and what you saved. And there's so much involved. So I used to just think I knew. But when we started putting the math and software, I went, oh, wow, not only do I think I know, sometimes I'm wrong and the math tells us otherwise. And then it's very interactive. So most advisors don't use that software because it's my software and nobody has that software. And yet I have not seen that software anywhere else because I've specialized it so we could see that very quickly and in seconds. And so some people need to, some people don't. Okay. I would prefer people not to need it so we could have a bigger legacy later if that is your wish. Now, if you are somebody that says, hey, I don't want to leave a legacy, I want to spend every dollar, maybe it's a strategy. But again, that's why we need to get to know you, what your plans are and all that kind of stuff. Because a lot of people who do get these income annuities, Randy, they've been paying a 1% fee for years. And a lot of them don't even need the income later because they're spending less, right? And so a lot of them aren't even turning it on, which is interesting to me years later. So we've been doing this for 20 years and we've seen a lot. And to be able to dial in and notice that and then go into Perplexity, one of our apps that does a lot of research for us, it's an AI app, for it to say, a percentage of people, do not turn these on. So you are correct, right? And it dials into what article said it, et cetera. It's important to do your research to know and to have these types of instruments that you can see in your financial advisor being willing to show you and go outside the box to be able to do that. So again, it's not cookie cutter. And a lot of people say, I go into this office and I've interviewed these different people, and it's just so cookie cutter. So you say you're not cookie cutter, now show me. And then by the end of their second appointment, they're just sitting back in their seats with their hands back with like, okay, this is good. I haven't seen anything like it. And I'm tickled pink because I know I'm doing a good job, and our team and our advisors are doing a spectacular job when I'm not sitting with you.
Well, one of the things that I can get from what Charisse just said is how much she takes into consideration when building that income plan. I mean, if you were to go do this yourself, you'd say, okay, I'm going to get $2,000 from Social Security, and I'm going to pull this from here, and I'm going to pull this from there. Are you taking into consideration taxes? Are you taking into consideration that later on in life you may pay off your house, or that you may pay off your car, or that you have to buy a car, and that adds another $600 a month to whatever you have in your budget? So there's a lot to consider. And to get the whole picture, I think that is one of the great advantages to sitting down with someone like Charisse, because she's going to ask you questions that you're going to go, wow, didn't think of that. Well, let's get that conversation going. 833-368-3680 is the number. Charisse will do a no-cost, no-obligation meeting. It's a complimentary retirement consultation. Big word for, let's have a meeting and get your concerns out on the table. 833-368-3680 or ZinniaWealth.com, ZINNIA Wealth.com. Sometimes I read these stories, Charisse, and I cock my head like a Cocker Spaniel and go, huh? So this is one of them. This headline reads this: my parents are in their 70s and they went to a lawyer to draft a will. He told them not to bother. I was like, what? It said, he said, it won't change a thing. Are there situations where you look at someone and say, you don't need a will? Or is that kind of weird advice there? I thought that was the very, very minimum basic that we all needed.
I just don't understand that. Yes. Every human being on this planet needs a will.
Okay.
Not every human being on this planet needs a trust.
Okay.
But everybody needs a will because it's your checklist of who's getting what. Like who's getting my NFL ring, who's getting my couch, who's getting my car. You can't put beneficiaries on that stuff. And depending on the states that you live in, they have different rules. So half of your assets could go to your siblings, the other half could go to your kiddos because you don't have this will, because I hire a stranger to come in to divvy your assets and they just follow the checklist from the government, right? So if you want your stuff to go to who you intended to go to, you need a will. Like, that is insane. That attorney should be fired. Maybe he was being lazy. Maybe he just didn't like the person. He's like, I don't want to do business with you. I don't know. But the will is one of the most important documents. But I'm going to tell you, I say that all the time because I want your stuff to go where you intended to go. But those power of attorneys are the most powerful, strongest things you can get in place. Your power of attorney for your finances and your healthcare surrogate for your health. Basically, it's the same thing. For example, for me, I have one family member that is my power of attorney for my finances. I have one family member who's the power of attorney for my health. And the reason why it's not the same person is because they're two very trusted people. But one of my nephews is my power of attorney for my health because I want him to keep the plug plugged in, right? He wants to keep Aunt Reese alive forever, right? And so spend my last asset on me until I take my last breath.
Okay.
Right? And then I have one person in charge of my finances who she is very smart and she'll be very, very good with the money and she won't let anybody abuse it. And so I'm not saying that my other person couldn't manage that, but to split it up, I thought it was really important, right? And have family do it that you really trust. So you need to have a power of attorney for your finances in case you get in a car accident, you can't make that decision, right? Maybe you and your spouse get in a car accident. Maybe you're traveling. So much can happen. I have seen everything. And every time I say that, I see something new. You need a power of attorney for your health. You can't make those health decisions. So it's usually your spouse. And then usually it's a trusted child thereafter. Always have an alternative person just in case if something happens to both of you. So you need those documents. I mean, what are they? $150, $250 a piece? Get them done. It will save time and stress, especially for your family. And then get that will done. What, another $200, $250? But if you package it up right and you need a trust, I mean, you can walk out the door fully fitted with a beautiful suit, wills, trust, power of attorneys, which will skip probate. You want to skip probate. The point to have all this stuff too is just help you skip probate, because if you die and you don't have everything set up and you don't have this thing called operations of law, all your beneficiaries on everything you need, guess what? Things go through probate. Your kids might not be able to sell your homes for years because it gets locked up in probate and they're paying insurance and taxes and it's just wasting money, especially if it's a prime window to be selling the property, et cetera. Bank accounts and properties are the biggest assets that go through probate, by the way, because people don't think they need beneficiaries on that stuff, but you do. And you can't touch it once you've died, your beneficiaries. So we want to skip probate, and we do that with the right beneficiaries on all of our stuff. And then if you can't put a beneficiary on your stuff, that's when you get the will to direct traffic, right? And then you get a trust to also help you not be contested in court in case you have a beneficiary that you wrote out of the will and trust, and they're like, no, that's my fair share, I want to get it. No, get a trust. Nobody's going to contest a trust. It costs way too much money. So there's a lot of things when it comes to getting the right legacy plan built out, that estate plan, who's going to get your stuff. It's, people plan on their incomes, on their assets, and how they want to enjoy retirement, but they do not plan for the ultimate distribution of their assets once they pass away. And that's where people, I think, really fail a lot of times. And so we really push that envelope with our clients, like, let's get this done, let's get it done. And we do, and people appreciate it. And it's just that I feel comfortable. I feel like, okay, now if something happens to me, my family doesn't have to stress as much. Things are in line. I even wrote down where I want to be buried and what I want, right? My wishes and who's going to get my money. And those things are just as important as making sure you don't run out of money at the same time.
And that is how the conversation develops as you sit down and you originally walk in and say, hey, I don't want to run out of money. How are we going to do these investments? Okay. Hey, I don't want to run into a tax problem. There's that conversation. And eventually this is where it goes. This is where what happens to my money, my possessions if I'm not here anymore. Let's get that all locked down. That's a part of the retirement planning process. Give Charisse a call. Take a look on the website. Here it is, ZinniaWealth.com, ZINNIA Wealth.com. There's a gold box on the website. You'll see it there. Click on Complimentary Retirement Consultation. That's a meeting where you sit down and start talking about your questions about retirement. No cost, no obligation. 833-368-3680 is the number. 833-368-3680. All right, so we're starting to get a little more information here about Social Security. We've talked about it before. Trust fund runs out in 6 years. The date is 2032 now, so things have moved up a little bit. The cuts, we have now been told, are going to be gradual, okay? So in 2032, the first year, your check will be cut back by 7%. And then over the next 3 years, it'll continue to work down all the way to 28%. So you'll be losing a lot of money in Social Security here unless Congress does something. But if you have a $2,000 check, if you take 28% off of that, now you're getting $1,440. And that's a yearly loss of $6,720. Now,
that can't happen.
That's a big number, and that's going to hurt an awful lot of people.
You know what's crazy? The fact that that's actually the plan. If they don't do anything.
Right.
Like they're actually like, well, if we don't, because clearly we're going to keep kicking the can down the road.
Right.
That's the plan. That is insanity to me.
Yeah. And they call it the third rail of politics because nobody wants to touch it. But it's going to come to a point where I figure they'll probably do something in the 11th hour, is right at the end. And it's not going to be something that fixes the whole thing, but maybe we can push this off just a little bit. I don't know. Charisse, so it's a reality. It's a reality. If it happens like this and you've got a bunch of clients that came in there making $2,000 a month every month on Social Security, and now they're getting $1,440, they're going to be coming in and they're going to be saying, Charisse, I need another $500 a month. How do we take care of that before we get there? We talked about this earlier. Let's head this stuff off before it happens. Yeah. What do we do? I mean, is this just basically an income conversation that we just need more income at that point?
Yeah, and it is a hard conversation because I truly hope that doesn't happen, but we can't plan on hope. We've already talked about it many a times. A lot of people hope and their hope gets derailed a lot of times because they don't have a plan. So if people are concerned about that, And we have talked to a few people about that in the income plan. I'll say, well, what if you lose 28% of your income? Mm-hmm. Do we have enough in assets to make up the difference? And I would say, probably say 7 out of 10 times they will, but that just means there's going to be less for a legacy later. And so people don't like that. But if we plan accordingly now with income checks, it's an easier story. But if we fluff things now and we overspend now, it could be a problem. So that's why we want to really dial in inside our income plan. We want to front load your go-go gears. We want to spend 20, maybe 30, maybe even 40% more than you ever intended. But if we do that, what happens if this happens? What happens if you need long-term care? What if Social Security does reduce by 28%? I'll be in Washington with a pitchfork. They'll have a problem. Don't make Charisse get into politics. That would just be poor planning. But I don't put it past the government because I feel like sometimes they just don't know basic economics. And the person who gets hurt the most is always the retiree, the one that saved the most. Mm-hmm. And now they're on a fixed income, and now they want to leave this legacy, and now they're finding themselves leaving less of a legacy because of taxes or because of whatever might be happening, penalties, surprises. And it's important to work with somebody who actually understands this and the politics of it, and show you what if that happens, how does that derail your portfolio? And again, I'm hoping that does not happen, but they are giving you guys deductions for collecting Social Security right now. And does that hurt us later on? I've always said that. I'd love to see the math. Like, where is that coming out of the blue? You know, if they give you tax-free Social Security, yeah, that sounds great. Why we're trying to get an election going here in the next couple of years. No taxes on Social Security. That's great. But then what happens in 2026, 27, 28, 29? Yeah. Like, do we pay for it there? Would I rather pay $5,000 in taxes or lose $600 in income? Yeah. It's almost equivalent, but there's a math equation that they've already figured out that's going to help them more than it's going to help you. So just listen to the noise out there. Sometimes that free stuff isn't what you think it is in the future.
Well, one of the things that I've talked about is debt management as well. A lot of people are going to go into retirement. Their house is going to be paid off. Their cars are going to be paid off. And that's a great position to be in. But if you're not in that position, what if you worked it out so that 6 years from now you paid off your house and you paid off your car? And all of a sudden now there's some more cash that's available, and maybe that makes up the difference that you possibly could lose in Social Security. So, Charisse, there's a couple of different ways to kind of attack this, isn't there?
Yeah, and truth be told, when we are building income plans, I'll show you, because a lot of people still owe 5 years, 10 years on their mortgages. Mm-hmm. I'm like, when this falls off, you're going to have, some people it's only $600, some people it's going to be $1,200, some people it's going to be $1,500 more in income. Right. And a lot of people forget to put that debt management part of the plan. So we don't ever talk about that on radio because I feel like it's a lot, but I'm glad you brought it up because that's actually very valid and very important. You have car payments. I always feel like if you have a car payment now, you're always going to have a car payment. That just means because you like buying new cars every 5 years, right? So you're probably always going to have a car payment. So we just pretend that doesn't ever come off the books till maybe 80 when your driver's licenses get taken away. Well, yeah. Hopefully that doesn't happen.
Been through that with Mom, and that's not a fun day. But you know what? No. She looked at me, and I remember she said, "Wait till you get to be my age, and you have to give up your driver's license." And I wanted inside of me to look back at her and go, by the time I get there, Mom, cars will be driving on their own. They already are. And there's Uber that you won't do. So there is some ways around that. But, you know, so it will change certainly for the next generation. You're listening to Retirement Coffee Talk with Charisse Rivers at Zinnia Wealth. If it's time to talk about your retirement, let's not put that off. Let's at least have a meeting to get your wheels turning a little bit. You've got all these worries and concerns about retirement. Is there going to be enough money? What am I going to do about taxes? What about Social Security? What do I do with Medicare? There's so many questions. Let's just get it started. Give Charisse a call. It's a no-cost, no-obligation meeting. 833-368-3680. Again, 833-368-3680, or use the website zinniawealth.com. All right, big question. How much do I need every month in retirement? Well, we're going to tell you. The new numbers are out. This is from the Bureau of Labor Statistics. Last year, the average retiree spent $5,000 a month, $60,000 a year. That doesn't seem like a big, heavy lift. You put your Social Security in there, and that seems like it can be done. Now, where did they spend their money? This is interesting to me. 36% on housing, 15% on transportation, keeping the cars going, 13% on healthcare. Still no fun here. 13% on food, 7% on utilities, 3% on clothes. Still no fun here. And then 3% on household operations. Oh, here it is. 5% on entertainment. That's $3,000 a year. That's ridiculous. Come on, people. All right. So that's got to be something. People come in. Do they know how much they spend per month on stuff to keep the house going? And do they know what that number will be in retirement? And do they think that the fund number is going to be a whole lot more than 5%, and then it gets to be a surprise or even a problem?
I will say 70% of the people who come in and see us, they know what they're spending on their bills, their insurance, if there's a mortgage, car payment, food, electric, cell phone. So they know that part. I think the part that is always hard to tether money and thoughts to is the miscellaneous bucket. And then that entertainment bucket, which is also the travel bucket. So $3,000 a year, when you said the average person is living on $5,000 a year in retirement.
A month.
I was like, that's not my typical client.
You think that's,
right? Our
that's
clients,
higher?
That's low. No, that's low.
Okay.
Our clients live on a much higher number. And that's because, I mean, a lot of them have their debts paid down, but the average monthly cost for their expenses could be between $3,000 to $4,000. So if it's $3,000, it's $36,000 a year. If it's $4,000, that's $48,000 a year. And then again, you need a $57,000 income to pay $4,000 in bills. Right. That's the gross amount because you got to pay the taxes afterwards. So then if you want to sprinkle in entertainment and you want to sprinkle in travel, you need at least another $10,000 to $20,000 to $30,000. So we coach our clients like, hey, let's see if we can hit that extra $30,000 just for travel. And we'll build in miscellaneous bucket, birthday present, Christmas presents. That's part of your fixed asset, right? So we try to coach people to do that. And then we create this other bucket for the entertainment bucket. Some people are like, Charisse, we're never going to travel. Our entertainment's movies and we like to do stuff in the yard. Then your entertainment bucket will probably be $10,000 a year, maybe. We had some people's like, Charisse, I'm going to do one cruise and we're going to go, do one other trip. So you probably don't need more than 15,000. But then we convince people, by the way, we're really good at coaching people up to go to Europe and do the Alaska 2-week trip, go rent a house and the Keys for 2 weeks and have all the kids come down, helping them spend their money on them and memories, right? And so we like to buffer the first 10 years with an extra $30,000 just on entertainment if we can. But how in the world can we do that if we don't build out a design plan, not a cookie cutter plan to give you confidence and be okay doing it? And every year we tweak it and we make changes. Remember, we are retiring by design, not by accident, not by hope, not by just call me when you need your income. We want to design the next 10 years of your life when you're retiring. Or if you come to Zinnia, because some people have already retired, you get 10 years with us to overfund your retirement in case you didn't get to do it before. So we're going to show you, can you do it? How do we do it? This is how it's going to work. Then we create the next 10-year plan and then the next 10-year plan. So we have 30 years with us. I don't care how old you are. If you're coming in at 70, we're going to assume you're living to 100, right? Just what if you do? You don't know. We do want to look at health and, what's happened in the past, of course, but we want you to have a design. And we do that with our Zinnia 5 strategy. That's our framework. And the philosophy is just retire by design, because these people in this example are not retiring by design. They're retiring by default, and they don't even know what's going on because I can see the math and none of it makes sense. So come in and do the math, because if you do the math, you'll know for sure where you stand.
You're listening to Retirement Coffee Talk with Charisse Rivers at Zinnia Wealth. And in the words of Larry the Cable Guy, Let's get her done. Come on in and let's do some math on your retirement. Give her a call, 833-368-3680. If you've been wondering about this, there's no reason to sit around and wonder. Let's get you some answers on what's going on. And if there's any gaps in your retirement plan, let's get them filled. Let's have an answer. As Charisse says, let's have a strategy for it. 833-368-3680. Well, Charisse, I know that there's a lot of people that love the stock market, but there's also a lot of people that hate the stock market. They don't like the risk that comes along with it. I love the fact that my money can go up, but boy, do I hate the fact that my money can go down. So there seems to be a nice little place in between for some people. The people at 24/7 Wall Street said, if you want to be in the market, but you hate the risk, but you want some growth, they suggest using a utility ETF. They say there's less volatility and pretty good returns. Have you found that?
That is, I'm calling BS.
Calling BS on this one. Okay.
BS on this one.
Okay.
And the reason why is I used to trade all of our accounts here at Zinnia. And I was really great at sector rotation. It was my favorite strategy. It's actually I love that strategy. And I've been taught, hey, the utility ETF, it is a safe way to go when markets are going down. Yet the utility ETF dropped 32% and stayed there for a year. It paid what, 3% dividend? Who cares? What is 3% to a 30% loss?
Yeah.
That's a Duke Electric. That's a Southern company. Those are your electric companies. And yes, I know there's times to get into utilities and a time not to get into utilities. But if you have a Fisher investment, they're not getting you in and out of utilities. They're keeping you there. So when it takes a dump of 30, well, you're feeling the pain. That's not a safe money strategy. I had to learn that. Right. And I realized, okay, just because ChatGPT, which wasn't here back then when I was doing that, but if you look at it now, says it's a safe place to put your money. Yeah. Why don't you look at the charts? Look at Duke Electric, look at Southern Company, look at Next Era. They stayed in the dumps for years. And it's like, where's my growth? So listen, we want safety and we want to build it in. But that is the most cookie cutter design that you can get at a big bank and brokerage firm. I can promise you that we will not be employing here at Zinnia Wealth Management. But we do active management. And sometimes you'll see that utility ETF in our portfolio because the timing is right. And then we'll have to pull it out because the timing's not right. Or we'll have less of it because it's starting to get volatile. So that's active management. So that's different than the buy and hold. So again, build in safe money strategies, growth strategies. And it's not just that basic strategy that you are all used to.
Well, what we want to do is find for you the retirement plan that not only works for you, but is also comfortable for you. And let's figure that out together. It's a no cost, no obligation meeting with Charisse. 833-368-3680. Give them a call and let's start the conversation. Just start talking through what your concerns are. 833-368-3680. Or if you prefer to use the website, it's real easy. ZinniaWealth.com, ZINNIA Wealth.com. And there's a gold box. And you'll see it. You just click on it. It says complimentary retirement consultation. It's a big word for let's have a meeting. No cost, no obligation. Let's just talk through your retirement. Again, ZinniaWealth.com. Here's something that came from Morningstar that I thought was pretty interesting that just kind of piles on that particular thing. And that is 70% of retirement plans that fail in the first 5 years of retirement. So that makes people go, oh, gosh, I don't want to spend too much. You know, they get wide-eyed like that. Why do you think that is, Charisse? Is that just people that don't have a plan and they just kind of charge into retirement and then 5 years in they go, holy cow, I'm spending more than I thought? What do you see?
So I see two versions of this. I see 50% of people where they're spending too much. And then I see 50% of people where they're not spending enough. And what happens with the people who don't spend enough, they're They don't have a pension. They typically only have a Social Security, and they're worried about running out of money.
Yeah.
So they spend less when really they could be spending more. And the other person doesn't budget very well and is very loose with their money, and they start spending a whole lot because they're thinking, oh, we're gonna make an average of 10% a year for the next 30 years in retirement. And what happens is sometimes there's a market drawdown, right? That roller coaster ride, maybe it's 10%, 20%, but you're still taking money out. And it hurts your portfolio because if you lose 10% this year, you have to make 11% to get to even. And the problem with all that is that if you're taking money out at the same time, it's like a double negative. And then it takes even longer. So you shouldn't be taking money out of the stock market when it goes down. So those people don't stop. They just keep taking it.
Got it.
And so we see, think what happened 2 years ago. Market went down 18%. And, it took 18 months literally to recover. So are you pulling money out every month during that time period when it's going down and recovering? That is a painful, hazardous domino effect. And so 5 years later, people were like, well, I'm not exactly where I thought I would be. Right. And if they would have had another bucket, they were pulling income out during the roller coaster ride, well, then they wouldn't have seen such a big hit in their portfolio. And the recovery time would have been much quicker, and they would have had their equivalent dollars. And so it's called sequence of returns risk, Randy. And it is the returns you receive the first 5 years in retirement. So you have to be extra careful those first 5 years. But I don't want to scare people. The thing is, you just need a plan, a written plan. You need to see it. You need to see that withdrawal strategy. What buckets are we going to pull out of? If the market goes down, do we shift gears? If the market goes down 30%, what is our exit strategy? Do we even have one? And really build that out so people can see it. And then on top of it, add that income plan where it's an inflation adjustable income plan each and every year so that you can keep up with inflation. I had a client who came in and said, hey, inflation's kicking my rear, Charisse. I actually need to really up my income. We pull up their income plan we created. I'm like, well, you're supposed to be taking this much. And so we're just off a little bit. So let's up your withdrawals. And she's like, oh, that would be helpful. Right. And so it's just ongoing maintenance of a portfolio and an income plan and that investment strategy. And most people don't know where to pull money out, Randy. That's the most confusing part. They're like, what is this withdrawal strategy? Like, I really don't know. Do I pull it from my taxable bucket, my tax-free bucket, my tax-deferred bucket? Do I have to do this Roth conversion thing? Does it make sense? Am I going to pay more taxes in the future? All those questions. And that's what we unravel here at Zinnia Wealth is where are you at? Where are we going? And how do we do it more conservatively than what your expectations are and still reap the reward that you deserve?
Well, this is one of the things that many people struggle with as they get into retirement if they don't have that income plan, that spending plan, that withdrawal plan that Charisse talks about. 833-368-3680 or use the website, which is ZinniaWealth.com, ZINNIA Wealth.com. There's a gold box there. Just click on that. Charisse, there's a lot of different kinds of people that come to see you with a whole bunch of different kinds of ways that they want to retire. A person who goes into retirement with a business, they want to sell their business in order to power their retirement. That brings on a whole new group of issues to deal with. There are 2 to 3 million baby boomers that own small businesses. They employ 32 million people and generate $6.5 trillion a year to our economy. They are very, very important, and they need some special treatment when it comes to retirement planning. Charisse, somebody comes in, my business is going to power my retirement. What's my next step? How does that conversation go?
Yeah, so we get a lot of people like that, and we have a broker that helps them figure out the value of their business and helps them sell the business. People sometimes come in the final hour where they're just done, but then it could take a couple of years, and you can't be done because if you sell the business, they might even want you to work a year or two. This is happening with my clients right now, and most people, when they're done in their 60s, they're done.
Yeah.
And they're like, I got to do this for 3, possibly 5 more years, possibly. So that succession plan is really important. And coming in 5 years before you think you're going to retire, you might not even know. You might say, hey, I'm going to work till I'm 65 and run this business till 65. And you could be 55 right now. I'm going to tell you something. That doesn't usually happen. Mm-hmm. I bet by 60, you're like, I want out. You might be there right now. So having those conversations with an advisory team that actually understands succession planning and the broker dealer type of deal when it comes to helping you sell and get that valuation. 10 years ago, I have a great example. A client came to me and says, I just want to sell this business, Charisse. I was like, okay, great. And actually, I'm thinking of two at the moment. And one of them was a plumbing business. And they made easy all day long. They netted like $250,000 a year, right? These are the next millionaires, by the way, because of AI. So good businesses to own. Well, he couldn't get anyone to buy the company. So you know what he did? He just retired.
Just dissolved it?
Dissolved it.
Wow.
And he could have all day long got a really good multiple on it. But he just tired of working, just was ready to go. And he's like, oh, I just don't want to deal with this because I have to train whoever it's going to be. And that's going to take 2 more years. I had another client who had another big, not a big company, but a printing company, and they did the same thing. And so I've watched it happen and I'm thinking, this is money. Like this, at least get $1 million out of it or $500,000 out of it. But when people get there to the wit's end, Randy, and they're just like,
I'm just
it's not even
done.
worth that chase anymore. And so a lot of these people clearly have saved enough money that they could retire in their dollars. But you're saying goodbye to a business that you have built, these companies they had built over 30 years, and just saying, oh, never mind. I'm just not interested. So instead of getting wore out and tired, come talk to us so we can help direct traffic before you lose, because that's a big investment you lose. Think of the interest rate. That's an interest rate return. You have $1 million and you get an interest rate every year to get it to 1.5 million. That doesn't happen overnight. So again, more money for legacy, more money for you, more money for long-term care. And let's work on that plan for you, because I hate for you to just lose it.
To sit down with Charisse and talk through all of those options and what looks good out there, and don't let it go to the last minute. If you see this happening 2, 3, 4, 5 years from now, come on in. Let's have the discussion right now. Here's the number, 833-368-3680. 833-368-3680. It's a no cost, no obligation look at your retirement. Really, it's just sitting down and having a conversation. 833-368-3680, or use the website ZinniaWealth.com, ZINNIA wealth.com. Hit the gold box and you'll be on your way. All right, I mentioned it before. Only 3% of Americans have saved $1 million or more for retirement. What I was shocked to find out was only 4% have saved between $500,000 and $1 million. That means 93% of the United States people who want to retire are somewhere between, say, 100,000 and 500,000. So, Charisse, let's talk about that area right now. Is that area of planning a lot different than the planning that you have to do for somebody who is more wealth? Tell me a little bit about that first.
Now, this is a 2-part question, because there's a yes and a no to it.
Okay.
So if you're somebody who has 250,000 to 500,000 versus maybe 500,000 to $1 million, there's 2 types of households. The $250,000 to $500,000 household always gets Social Security checks, but sometimes they get a really big pension check. So their money went into that pension strategy, and then less went into the 401k. Okay. That person, we see that person a whole lot, where they have the pension, they have the Social Security, they might have $500,000 or $250,000, and they're only tapping into a little bit of what they saved, because the pension and Social Security pays their bills, the gas bill, the light bill, the food bill, and it pays the travel. So you don't have to have this big bucket of money to offload for your travel expenses. And so what we find is we use it for inflation when inflation kicks in. But some pensions have that cost of living increase. So that's one. But once in a while, here's where the planning totally changes here. We'll see somebody with 250,000 to 500. We're a wealth management firm. We need you to have 250,000 to 500,000 at minimum for us to do our job for you and create these plans. That person will get a totally different plan if they only have Social Security and no pension. They will even get a totally different plan than the person who has 500,000 to 1 million that still only has a Social Security check, because there's less saved. So what we have to do, and I don't like doing it, but this is what we have to do to make sure you win the game and get the paychecks you need. We have to buy income for you. So we build in these buying income strategies that guarantee an income stream for the rest of your life and for your spouse's life. So we're building in that pension you never received, because with less money, you can have more income if you buy it right. And it's a timing thing, right? And now let's say you have 500,000 to $1 million and you only have Social Security checks. Well, we might not need to buy income, right? Depending on what you need to cover the gap that Social Security doesn't cover. So we might very well just put it in all of our investment buckets and safe, risky, moderate, however we do it. But once in a while, if you are not out of debt and you're collecting Social Security and you have that 500,000 to $1 million bucket, I do have to buy income for you and still have an other investment bucket. So that it can be a total different strategy. Now, if you're 1 million to 1.5, 1 million to 2 million, this is a really easy strategy. You guys make it really easy for me to build these income plans because we're going to just mix it all up. But you will not get a buying income strategy if you have $1 million to $2 million. So it is not cookie cutter here. Everybody's plan is dialed in differently. And the advisors here know how to manage it and what to do, whether it's tax loss harvesting strategies, tax strategy, the buying income strategy, the investment strategy, the note strategy, the treasury strategy, the investment plan strategy, the active management strategy, the exit management strategy, you name it. And the reason why we built our business this way is because when I got in the business, everybody that sat with me for the very first time that I would do these workshops in the villages in Ocala, and they'd be like, do you do cookie cutter? I'm like, what's cookie cutter? And they would tell me, and I'm like, yeah, that's pretty cookie cutter. I do that. And I went, well, I don't want to be like everybody else. So I learned through the mouths of my clients and I grew from that. And I took so much wisdom from them. And I've been able to work with Yale professors, finance professors that help to walk through that. Other financial gurus, other advisors that have multi-billion-dollar companies. I just kind of tagged along and learned. I'm like, I want to be like you guys. And by doing that, we have really just paved this platform and this way for our clients just to be, okay, I like this. This is different. You got software you're going to show me, and we're going to tweak our income plan every year. We're going to use your tax software too to leave a bigger legacy in the future and all the while pay less taxes over the next 20, 30 years. They're like, who are you? Where have you been my whole life? So I'm really proud of it. So I'll brag about it. I'm not braggadocious, but we work so hard here, and I work so hard building this business, and so have our team and the advisors, that we're really proud, and we have a lot of fun here, and we have a great culture. So we got to have a plan. It's got to be in writing. That is number one. The investment plan is very critical, but the most critical component of the entire plan is the written income plan, where we shine and most brokerage firms and advisors fail because they just don't want to do it.
Well, I think that one of the main differences here, when you think about it, if somebody has really nice wealth, if they have $5 million and the market goes down 50%, they still got $2.5 million left. If you have 500,000 and the market goes down 50%. Now you've got 250. Now you're wondering if you're going to run out of money. Now you're wondering if you're going to make it. And so your strategy has to be a little bit different. There's going to be more toward income. There's going to be more toward protection. There is going to be a whole different kind of strategy for you. So that is what we talk about every single week, where everybody's plan is going to be different. It's going to be customized. It's going to be made specifically for you. And there is a place for you at Zinnia Wealth. Give Charisse a call. Here's the number, 833-368-3680, 833-368-3680. Use the website as well, which is zinniawealth.com, ZINNIA wealth.com. There's a gold box there, and it says complimentary retirement consultation. What is that? That means we're going to sit down and start talking. We're going to start to do the math on your retirement. What have you saved? What have you done? What do you want to do? And let's put it all together. Again, 833-368-3680. Charisse, that is all the time we have on this one, and I'm going to give you the last word.
If you want to spend more in retirement, pay less potentially in taxes, and be more diversified, you're going to want to hear this show. So as usual, live by design and not by default, and we'll see you here next week.
This has been Retirement Coffee Talk. To find out more about how the strategies we've discussed on this program can build the retirement you've been wanting, call Zinnia Wealth at 352-368-3680 or visit us online at zinniawealth.com.
Investment advisory services offered through Zinnia Wealth Advisory, LLC, a registered investment advisor. The firm only conducts business in states where it is properly registered or is excluded from registration requirements. Registration is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. Insurance products are offered through Zinnia Wealth Management, LLC, Florida license L078655, and Charisse Rivers, Florida license P037744. Zinnia Wealth Advisory, LLC, and Zinnia Wealth Management, LLC are affiliated entities. The information presented is believed to be current. It should not be viewed as personalized investment advice. All expressions of opinion reflect the judgment of the presenter on the date of the podcast and are subject to change. The information presented is not an offer to buy or sell or a solicitation of any offer to buy or sell any of the securities discussed. You should consult with a professional advisor before implementing any of the strategies discussed. Any legal or tax information provided in this podcast is general in nature. Always consult an attorney or tax professional regarding your specific legal or tax situation. Any client experience discussed on this show are unique to that client. Annuity and life insurance guarantees are subject to the claims paying ability of the issuing insurance company. If you withdraw money from or surrender your contract within a certain time after investing, the insurance company may assess a surrender charge. Withdrawals may be subject to tax penalties and income taxes. Persons selling annuities or other insurance products receive compensation for these transactions. These commissions are separate and distinct from fees charged for advisory services. Insurance products also contain additional fees and expenses. Social Security rules and regulations are subject to change at any time. Always consult with your local Social Security office before acting upon any information provided herein. References to specific investments should not be construed as being past specific recommendations. The returns for various indices discussed in this podcast do not represent the performance of the firm or any of its advisory clients. Returns do not reflect the impact that advisory fees will have on an investment. Past performance may not be indicative of future results. All investment strategies have potential for profit or loss. Different types of investments involve higher and lower levels of risk. There is no guarantee that a specific investment strategy will be suitable or profitable for an investor's portfolio. Historical performance returns for investment indexes and or categories usually do not deduct transaction and or custodial charges or advisory fees, which would decrease historical performance results. There are no guarantees that a portfolio will match or outperform a specific benchmark. Investments in fixed income products are subject to liquidity risk, market risk, index rate risk, credit risk, inflation risk, purchasing power risk, and taxation risk. Because bond prices fluctuate continually, their yields change constantly.